If you're inheriting investment properties, just making sure that you are really crystal clear on the tax implications of if you do sell the property, and really consider, if you're still in your 30s and 40s and you're still in the process of building up your wealth for the future, can you not pay that tax, or at least not pay that tax now, or for the next decade or so. Use the equity, use some smart debt, make sure you cover your risk and do all of that smart stuff, but use that to end up with a whole bunch more assets
versus selling it down now and paying the tax now and pissing the money up against the wall.
And then the other one was the 6-year rule on the own home, or it could even be investment properties as well. That scenario, inherit an investment property, move into it for a period, particularly if you don't have another property, nominated principal place of residence, 6-year CGT free window, that can soften the CGT that you might pay as well. Or on the own home, if you move in and you wanted to use it as an investment property, then you could do that and again not pay the CGT as well.
And then that pre-85 rule as well, which I don't think a lot of people would know, right? If it's purchased pre-85.
That's a huge advantage if that is the case. Definitely a big saving on the tax side, but again, look at the property, because if you're selling a property just to buy another property and you're incurring agents fees and sell costs and purchase fees and stamp duty again, that probably doesn't make a ton of sense if you've got a good property to begin with either. But if you're inheriting a significant amount of money, make sure you get a good financial plan so that you're making the most of the opportunity. There's a few mistakes to avoid as well, and you want to make sure that it works for today, make sure it works for 6 months down the line and fits in, because there's a lot of different ways to be right when it comes to your money, but there's really probably only 1 or 2 ways that it's going to be actually right for you.
Agreed. And then it sounds like as well, like make sure you've got a will in place that is 100% sort of compliant as such, it's going to work and it's going to protect whoever it is that you want to inherit the money.
Will in place as a first step, and once you've got a little bit going on, or you're on a strong trajectory with your investing and your wealth building, pay the bit extra to get the testamentary trust provision in there. Because the other thing, and I probably should have mentioned this, but with a testamentary trust, you can choose not to enact it. You can have the provision in your will, and if your beneficiaries get it and go, oh yeah, actually no, I've got my financial advice and I know that this is rock solid and I don't actually need it, I'm not going to benefit from it, you just don't do it. And it's simple. It's like an option rather than a mandate, and so options are always good.